Welcome to this Finbot Insights Explainer. Today, we're going to dissect a prevailing and perhaps dangerous illusion in the market. We're going to deconstruct this, let's call it crude but very sharp observation. The idea that serious dangers are hiding in plain sight right inside the world's most popular investment funds. You know, for years, the philosophy of John Bogle has been treated as gospel. The idea that index funds like VOO and VTI are the default for simple, diversified investing. But this core belief, well, it's time it faced some critical examination. The accepted wisdom, what you hear everywhere, is that when you buy VOO or VTI, you're safely buying the entire market. We're about to show you how that wisdom has slowly transformed into a dangerous illusion of safety.
Okay, so the first and most important myth we need to dismantle is this idea of diversification, because what these funds have become is effectively a seven-stock market.
The sheer scale of this concentration is really something. As of mid-2025, just 7 of the largest tech companies make up a staggering 34% of the S&P 500's total market value. Let that sink in. And that concentration directly shapes the performance. In 2023, those same 7 companies were responsible for 63% of the index's total positive returns. This means the performance of the market isn't the market at all. It's really just the performance of a few giant stocks. So what this really means is that you, as an investor, are no longer diversified across the economy. You're actually making a very concentrated bet on a single sector. That fundamentally violates the whole point of index investing for risk management. This level of concentration introduces a profound systemic risk, which challenges our second myth, the idea that the market is just inherently resilient. That's a belief that was severely tested back in early 2023. The rapid collapse of Silicon Valley Bank in March 2023 wasn't just some isolated event. No, it was a warning shot. It revealed a deep fragility inside the tech-heavy financial world that these major indices are now built on. And the market's reaction was swift. In response to the crisis, the S&P 500 had its worst weekly drop of the entire year. It was a clear demonstration of how a problem in the tech sector could instantly infect the performance of the entire index. This really forces you to ask a tough question. Without that massive government intervention, where would the technology sector have gone? It's a stark reminder that the system required a bailout to prevent a much, much longer downturn. The way the system was popped up exposes our third myth. This idea that the market's quick recovery was driven by strong fundamentals. In reality, it was rescued by an entirely new narrative. Think about the contradiction back then. The economic reality was persistent inflation, aggressive rate hikes, and regional banks failing. But the market narrative? That was all about one thing, the generative AI boom. This AI-fueled surge sent the Magnificent Seven soaring to new highs, and in the process, it put a mask over all that underlying economic weakness. This heavy reliance on a single, speculative theme casts some serious doubt on just how sustainable these recent returns really are. And all of this brings us to the core of the issue. It's a significant distortion of what John Bogle's original investment philosophy was all about. See, the classic Boglehead strategy was about genuine global diversification. You had a U.S. stock fund, sure, but you also had an international stock fund for geographic balance and, crucially, a total bond market fund to lower your risk and protect your portfolio. What do we have now? The modern mantra is just VOO and chill. It's this oversimplified, U.S.-centric approach that completely ignores international markets and the risk-reducing power of fixed income. This new philosophy, let's be blunt, is not about prudent long-term risk management. It's about short-term performance chasing. It's a herd mentality, blindly following recent winners, which is the absolute opposite of the disciplined strategy Bogle actually advocated for. So the evidence really compels a serious reevaluation of what it means to be a passive investor in today's market. And this leads to the ultimate question you should be asking yourself. Is your supposedly passive portfolio now passively reckless? You have to actively decide whether your safe, simple strategy has accidentally become a highly concentrated, high-stakes bet. For more insights that challenge conventional thinking, please click like and subscribe. And remember, this is for informational purposes only. It's not financial advice. It's so important that you don't trust social media influencers, and that includes us, with your financial decisions. You should always, always conduct your own independent research.